Hello, good morning. My name is Jamal Khan. I'm the head of tax at Churchill Tax Advisors. Today is Monday, 16th of September, and we are presenting our weekly tax update. We will go through some recent tax cases, but before that, some recent developments that we have come across. HMRC have been targeting or running a campaign against landlords who have not declared rental income correctly. HMRC have now got a very strong database called Connect, and they also receive information from local boroughs where landlords have been renting out properties, and they compare that with individuals who have been whether either filing or declaring the rental income or not. We have seen in the last couple of years, even in the last few weeks, landlords receiving letters, notices from HMRC, and stating that you haven't been declaring. We have information that you have not been declaring the full rental income based on their records. So the landlords are then given a choice of whether to make a declaration or not to make a declaration. And usually when the clients come to us, we use something called the Let Property campaign that allows us to declare rental income going back to, say, 20 years. And this also allows us to keep the penalties to a minimum, and without having to refile tax returns or file tax returns for 20 years where the penalties could be significantly higher. We have seen cases where other accountants and advisors have advised clients to file tax returns for 20 years. When they do that, the penalties for late filing far outweigh the actual tax liability for the rental income. But if we follow the rental income, the Let Property campaign route, it's a lot quicker. The next point that I wanted to talk about was trusts. A lot of people are familiar with trusts, and trusts were used for tax planning. However, in my view, since 2006, when the trust taxation was reformed, now the trusts are very less attractive, in fact prohibitive, for tax planning, especially for large estates, because when most trusts are taxed as discretionary trusts. So when say somebody has a property portfolio worth £10 million or £5 million, if those are transferred into a trust, that can raise an immediate tax charge, inheritance tax charge. Although the capital gains tax can be delayed, but the tax charge or the lifetime transfer tax of 20% still applies. The trust tax rate, income tax rate, is 45%. There's a 10-year charge. So for those reasons, we are at this moment in time, we're seeing more clients who come to us who want to dissolve a trust and get their properties out of the trust, because the admin burden and the cash flow problem due to high taxation can be very damaging. The next point, we now move on to some of the cases for that have been announced in the last week or so. Very interesting cases. In the case of Cusins versus HMRC, this was an appeal that was filed by the appellant. HMRC had raised assessments, discovery assessments, or assessments based on the information they felt they had. In fact, the taxpayer, Mr. Cusins, wasn't very cooperative during the tax investigation that had been going on, and HMRC said, well, if you're not going to provide information to us, we will assume that you made a 50% margin on the sale of scrap cars or second-hand cars. And they assessed him with significant amounts. Mr. Cusins appealed to the tribunal. He said, well, these assessments they've raised are completely ridiculous. They are baseless. The tribunal looked at the circumstances, and they said, well, yes, if they were to raise assessments, they asked HMRC, do you have any basis for your calculations? And HMRC didn't have any basis for calculations, but they stated that this was best judgment. Best judgment is something that HMRC use often in cases where there are underdeclared sales. But in this case, although they had stated this was best judgment, they were not able to satisfy the tribunal judge that how they had arrived at their figures. The tribunal judge asked, would it be practical to make 50% profit on scrap cars, and they couldn't justify that, and therefore the whole assessment and the penalties and everything was cancelled, which is quite a good result for Mr. Cusins. I mean, although he was completely not cooperative, he had given HMRC officers a very difficult time during the case, but ultimately he got the results. So it's an unusual case, but something to watch out for. If HMRC are being unreasonable in raising their assessments, they need to that can be challenged. The next case is that of Nauruzi versus HMRC. This is a very interesting case from my perspective. Now in this one, in fact something similar we've taken to the tribunal as well recently. Mr. Nauruzi had received capital gains tax assessments against which he appealed. He appointed a tax advisor, an agent, an accountant who was supposed to be representing him and writing to HMRC. So he relied on his agent. Now, time went on, the agent stopped corresponding with HMRC, but kept on telling Mr. Nauruzi, don't worry, this will be taken care of, you don't have to worry about anything. He missed the deadlines, the matter went to the tribunal, he did, and his case was struck out of it because there was no representation. But Mr. Nauruzi didn't know about this. Now, what's important here is Mr. Nauruzi found out some 2 years later that his case had been struck out and he had to pay. So he filed a late appeal with the tribunal. They only have 30 days to appeal, but he filed an appeal after 2 years. The inspectors objected to this. The HMRC objected to this late appeal. It went to the tribunal. The tribunal judge considered that yes, it was late appeal. It was very late, but Mr. Nauruzi was genuinely under the belief that his case was being taken on and all the deadlines were being met by his representatives, which they didn't. And it would be very unfair for HMRC to take the tax. And it would be a miscarriage of justice effectively if he wasn't given a chance to represent his case, and therefore the appeal was allowed. And it's yet to be seen how the ultimate what the final assessments are, but I'm sure that it will be significantly lower than what HMRC have assessed him. The next case is that of Home E-Sub Limited. Effectively, this is a Subway franchise operating 5 stores. HMRC did invigilation visits and checked whether the correct amount of VAT was being charged. HMRC raised assessments based on cold, hot food, or whether the food was being eaten in, or the sandwiches were being eaten in or taken away, because that changes the VAT assessment or the VAT charge. HMRC's assessments were quite high. The taxpayer appealed to the tribunal, and although the HMRC didn't have enough information, but they still raised assessments based on best judgment, which we've discussed before. So the taxpayer's contention was that these best judgment assessments are very wrong, and when they were tested in the tribunal, the HMRC's assessments could not justify the basis, or could not justify how they have arrived at these figures. So once again, HMRC lost this case of best judgment, which they have used many times before, even in the cases that we've seen. But on these cases, rather than going to the tribunal, at Churchill Tax Advisors, we settled these cases through alternate dispute resolution, which is less costly for the client, and it's a lot easier. It's better for both parties to reach a resolution. We have very rarely come across cases on best judgment where we would take them to the tribunal. But I mean, as I said, this case was taken and it was won. So it is quite a good news, and something that can be used by other taxpayers during tax investigations when HMRC have raised best judgment. If you like our YouTube videos, please like them on YouTube on the channel. You can subscribe to our channel as well, and if you would like to call us, the telephone number is 0207 998 1834. Thank you.